India's debt is rising. Analysis of the new debate level and its impact. Everyone has heard that when life gives you a lemon, make lemonade out of it. But nobody talks about the situation of how, if a lemon drop gets in the ice, how much trouble it can be. This is what has happened with India. When in the 2000s there was a sparkle in the sky and the economy was booming. India saw an investment. This was fueled by state bank dishing out a load of loans for big infrastructure projects. However, some companies taking advantage of this boom couldn't keep up and defaulted. Hence, bank generated non-performing asset NPAs and struggled to give further advances. To keep business moving, shadow banks stepped up. These financial institutions didn't follow traditional banking rules and made up an estimated 1 by thirds of all new loans. Eventually, in 2008, shadow banking giant IL and ILNFS defaulted on debt repayment. Its collapse, its collapse sent shockwaves through the economic and shook up more traditional banks that supported the sector. This this had a ripple effect and everything went south onwards. Currently, the icing on the cake is COVID 19, the pandemic that shook the world economy and destroy the integration among. COVID has compelled global government agencies to spend and simulate liquidity to spur demand in the economy. How has India helped up in the past? India has been the fastest growing economy. It has been taught as an economic and geopolitical counterweight to China. But in 2020, but in 2020, but in financial year 2020, its growth fell to its lowest in the 6 years. Investments have weakened and unemployment has risen. Between 2006 and 2016, rising income lifted 271 million people out of the poverty, that is, people below the poverty line reduced from 55% to 28%. All development policies, including Swachh Bharat, were supported by a booming economic, but during financial year 2019 third quarter 2019 quarter 3, that expansion had contracted. India's economic output grew by a mere 4.5%, which was at its weakest pace. The many economists have said that the India's growth problem was are self-inflicted due to the ripple effect of the fall of NBFCs, NBFC, NBFCs. It's become difficult for people to buy luxury items such as cars. In heart of the automotive industry, which is one of the biggest in India, in 2019 the automotive sector suffered the worst, and the more than 1 lakh people lost employment. Agriculture and constructions were also hurt. What is the position of India's debt? In 2019, India stood up 8th position with 69.2% debt to GDP globally. The US was at the first with $23 trillion debt, that is 104.3%. Debt to GDP is an important measure to analyze how much a country owes debt, debt concerning its GDP. Let us understand this through one of the best example. In the data released by IMF in October 2019, India had a debt of 185 188 sorry 1851 billion dollar, and Pakistan had a debt of 226 billion dollar. Now you may think that this is because either Pakistan is lucky or its authorities are efficient. What we forget to analyze is that the Pakistan's GDP is away lower than that of the India's. When we compare the debt to its respective GDPs, we will find that India's debt to GDP was 68.1 while Pakistan was 71.7%. See the difference. Why does debt occur in India? Why does a country need debt? The country's central bank can simply print the money, right? Well, no, it's not that simple. It's not that simple. You see, for example, a country spend thousand rupees on infrastructure, but generate only 800 and needs to finance the country with a 1200. So the country would have to borrow. Now, how does a country's government borrow? There are two type of debt: external debt, internal debt. Borrowing from IMF, World Bank, and international banks. External debt borrowing from IMF, World Bank, and international banks. Internal debt borrowing from banks, the public, in the form of securities. A country's total debt expand with the needs for expansion through new infrastructure. When a nation borrows and uses the fund in building infrastructure, it improves its capacity to grow at a faster rate. Without relevant context, this debt to GDP figures can be overwhelming. The US has a debt to GDP above 100%, whereas Japan has already crossed 200% in 2019. The boom and bust. Have you seen the movie The Big Shoot? It's explained how the booming housing sector in the US economy lead to more constructions and buying, and the eventually defaults occur and the bubble burst. He gives rise in a huge amount of debt and a fall in a stock market. This was the situation in the beginning. The economic booms, people take loans, people have more money, so they buy more to improve the standards of living. There comes the point where debt surpasses the income, and now the people can't pay it off. This result is the burst of the bubble. Short-term debt cycle. The small repetitive rise and fall of debt. Long-term debt cycle. The short-term debt cycle are made of boom and bust, but the short-term debt are scaled for a long-term debt line. These long-term debt cycles comes once in every 80 to 100 years. impact of COVID-19 on India's debt. Indian economics wasn't in the great shape before COVID-19, so only been it has only been worse after. The report by the RBI Expert Committee on a Resolutions Framework notes, notes that the pandemic has affected the best of companies and businesses that otherwise were viable before. Expert experts believe that the banks may be more risk averse to reconstructing loan this time. Time having reconstructing loan this time around, having already suffered big losses in previous reconstructing effort. Around 19 sectors that were not under a stress before the pandemic have been hit and account for rupees 15.5 lakhs crore of debts. Retail and wholesales are worse affected with an thousand debts of 5.4 lakhs crore, and 11 sectors which were already under stress have been affected widely. NBFS having rupees 7.98 lakhs crore worth of debt. Position of India debt. Position of India's debt. General government debt stood up 66.4% of GDP in financial year 2000, and since then it has been rising. According to a report by Motilal Oswal Financial Services, the debt to GDP ratio stood up 75% in 75% in financial year 2020. It is most likely to accelerate. Government debt is a combination of liabilities of centers and states. Now the debt ratio is likely to hit a record of 91% in financial year 2021 according to the report. This will be highest recorded debt since the 1980s. The report also predicts that it is unlikely to fall to 60% by financial year 40 without further hurting growth. The report also predicts that it is unlikely to fall to 60% by financial year 40 without further hurting the growth. Why is the government debt increasing? Government debt increases as a result of government spending. Now there are dented revenues and fiscal deficit. The debt is rising. Additional expenditure to tackle COVID-19 as well as the reductions of economics activities, mainly manufacturing, is basically what is pushing the debt to GDP even further. Also a large economy generally means the country's capital market will grow and the government can tap them to issue more debt. This means that a country's liability to pay off its obligations and the effect that the debt might have on the country's economics is dependent on how large the debt is as a proportion of the overall economy. In 2019, the Indian economy struggled to pick up the steam, and the government faced government faced contracting tax revenues along with low domestic saving. The government thus proposed tissues debt in the international market to raise funds. Household borrowing has also been very high. Due to the pandemic, the GDP saw a decline of 23.9% in the quarter 1 financial year 2020. The fiscal estimate estimates of all economics across the globe have gone awry due to the impact of the economic contraction, con- contra- contraction and COVID-19 related expenditure and stimulus. Debt to GDP can be controlled by two factors, either increasing the growth, which due to the global recession is not possible, or decreasing the debt, which due to the need of the population and industries is not possible. How is how is this increasing debt and deficit going to impact the economy? As previously discussed, the debt to GDP ratio implies how like how likely to country will be able to pay off the obligations. The higher the ratio, the less likely it is that the countries can pay off its debt, and hence the default risk is high. Global investor and credit rating agencies often see this ratio to evaluate the government ability to fund its debt. According to a World Bank report, if the debt to GDP ratio exceeds 77% for a prolonged period, it will slow down economic growth. The anticipated surge in the ratio will restricted in spending. A MOFSL studies cites that if the primary spending growth is to 7.3% in the next decade from the past decade 11.3%, it becomes apparent that the government will be unable to grow and attract investment. This could impact the non-interest revenue spending such as a defense salary, pension, etc. Government capital outlay Government capital outlays have been playing a bigger role in economic growth for many years, and thus if that gets impacted, so will the GDP growth. Conclusion: public debt in India occur when a country has to cover the debt deficit, to fight financial depression, to finance public expenditure, to carry out welfare program, and to create infrastructure. India is in a difficult position and has no way to go forward unless better monetary and fiscal reforms are introduced. It can it can neither reduce the debt nor expand the growth. India will not be able to bring its debt to GDP percentage below 60% even by financial year 2040 without hurting the growth. The only way for the India to get out of this situation is to accelerate rapid growth in the economy by boosting demand. Foreign debt service servicing capacity may be strengthened by export promotion, and also by import situation sorry import substitution. The government must take some steps to strengthen export. In this tense situation of in this in this tense situations of a standing at the brink of a major financial crisis, there is a crucial need for India to link growth with development and fill the gap between macroeconomic performance and the social sector's development. Thank you. Demand in the economy. How has India held up in the past? India has been the fastest growing economy. It has been taught as an economic and geopolitical counterweight to China. But in 2020, but in 2020, but in financial year 2020, its growth fell to its lowest in the 6 years. Investments have weakened and unemployment has risen. Between 2006 and 2016, rising income lifted 271 million people out of the poverty, that is, people below the poverty line reduced from 55% to 28%. All development policies, including Swachh Bharat, were supported by a booming economy, but during financial year 2019 third quarter 2019 quarter 3, that expansion had contracted. India's economic output grew by a